Hey everybody, Brian Shannon here from alphatrends.net. Today's Sunday. It's the 18th of January 2015. Let's look at these markets. For the week, the S&P 500 did lose 1.25%. The NASDAQ 1.75%. Equities across the board were lower, with really financials leading the way lower with a decline of 2.6%. We did see bounces on Friday, but as we'll see in a moment, the trends are still quite suspect. So let's take a look at the charts here and see what we have. The S&P 500 on the daily chart, it's still really a mess in here, and if we take a look and drill down a little bit on a 30-minute time frame, you can see that we've had obviously this as 198 to 200 basically is the important band of support that this market is currently holding above still. We had a bounce back Friday, but it is below, it's still got a declining 5-day moving average. There's nothing really bullish about this market here, and for us to get intermediate term neutral, I think we have to get back above and hold above 202-ish, and ideally we'd like to see that 5-day moving average flatten out a bit. But we still have the pressure building with these lower highs in here, and the more times the market comes down and tests this band of support, it weakens the resolve of the buyers in there, and inevitably will likely lead to a breakdown. Now that's not a reason to go out and rush to get short, but if it breaks down below this band, 198 to 200, then I think that we could be looking at something more significant on the downside. For now, it's trying to turn neutral at best, but still with that 5-day moving average declining, guilty till proven innocent. So the NASDAQ 100 also lost ground this week, and it's into a key band of support in here as well. We keep seeing these lower lows, so we still have the pattern of lower highs and lower lows since the peak late last year in November, and so a pattern of lower highs and lower lows is what we're seeing here. The market is maybe trying to stabilize in this area. We keep making these cheap new lows, and then we get a bounce, but the path of least resistance is clearly still lower on the intermediate term time frame. For us to become neutral, we're going to have to get back above and hold above 101.50 this coming week, and for it to get positive, I think for us to think that it could probably sustain a rally, 103.50. So it's got a lot of work to do, and here we are, of course, in earnings season. The big loser this week was the financials, and that's where we saw a lot of earnings come out. So we broke a very important level of support in here, and we got a bounce on Friday with heavy volume, but it's still a bounce within what's an intermediate term downtrend. And year to date, the volume weighted average price is up at $23.80. That's also where we see, of course, that there's prior support. So this looks like a likely area for resistance to be found. It's a potential level of resistance. We don't know if it's resistance. We'll know if it goes up there, test it, and is rejected. Then we can say in hindsight that it was resistance. But for now, it's a potential level of resistance. We've got a declining 5-day moving average. And on the intermediate term, it's guilty till proven innocent. Yes, you can trade it to the long side when it's above the volume-weighted average price for short-term trades, but don't expect it to turn into something bigger, not when we have a declining 5-day moving average, and not when we have a prior big band of support broken that's there standing in front of this market to hold it back potentially as resistance. The Russell 2000, just a mess here. I mean, really just a choppy mess. Looking at the 30-minute time frame, it doesn't give us any clarity here either. For this market to turn more neutral, I think that we need to see it back above 117.50, and for positive, probably up near 119.5. So really, this is a market that is best suited for aggressive, skilled traders. It's not a market that's being very conducive to swing trade setups. The temptation is to get involved in stuff because you think it's down too much, and it's the beginning of the year, and you want to you want to start out the year and pad your account with some nice profits. But the message of the market is that it's the beginning of this year so far is a time to go slow if you're a swing trader, and kind of sit back and hold on to your cash and wait for the right opportunities to present themselves. So far, the low risk, high potential swing trades really aren't setting up that much. If they are, it's mainly to the downside. So again, if you're looking to make changes to your strategies and more more importantly, with your results, you have to listen objectively to what the market is saying, and don't give in to the temptation of wanting to make these big profits or feeling left out on the day, on the days where we have rallies in these downtrends. Some of the biggest rallies, one day rallies, typically occur in downtrends. So don't feel left out by it. Just look at it and say, I'm being disciplined. I'm getting in, with smaller share size, maybe tighter stops. Do what you can to control the risk. We're in a period of heightened risk awareness right now. The semiconductors, just looking at the chart, we have a pattern here that it shows lower highs and lower lows. So in order for us to become more positive, we need to get it back at least above that level. So, the semiconductors, look at the weekly chart. We're in a strong uptrend. We're correcting, and the intermediate term says, we've got a giant mess here. Look at the volatility in this market. It's just not conducive for swing trades. You simply can't look to hold for a directional trade for a couple days in either direction. If we get back to 54.50, we'll become more neutral. Right now, we're just in a big, choppy, messy range. The biotechs, they continue to be the stronger group out there, and for the week, the biotechs did gain ground. So we were up 1.4%. We're up close to 5% year to date in the biotechs. So they're obviously the bigger area of strength. They've had a tremendous rally, and that means that there's heightened risk awareness. But the path of least resistance is higher, although it is choppy. It looked like we were breaking important level of support at 310 because this was prior resistance, 310 really to 311. This prior resistance in here had become support. We broke below it, but then the buyers came right back very quickly. So even in this market, you can look at it and say it was up 1.7%, but that 1.7% did not come easily to people who were holding for the week. The U.S. dollar continues to strengthen or continues to show strength. The the more important intermediate term level of support in there is about 24.25. As long as we remain above 24.25, 24.30, the path of least resistance continues to be higher in the U.S. dollar, and those who are calling for its demise, its death, it's overdone, whatever, will continue to face the mounting losses in their accounts. The treasuries continued higher this week as well. They they were down a little bit on Friday, 1.2%, but for the week they finished with a 1 2/3 percentage gain. So the U.S. bonds continue to do well, and let's talk about it. I'm going to talk about it again. Gold, as I mentioned last week, I thought it could get going, and here it is. But again, it's it's at a declining it's back above that 200-day moving average. We've got this trend line here that it's trying to hold above. So anyways, again, the thing about gold for me is I don't trade it, and it's just something I'm not going to talk about, so I probably shouldn't have brought it up again there. Anyways, let's take a look at some stocks here. Apple, we were cautious on this stock, saying that for it to become neutral, it would need to get back above here, where I was thinking that maybe it could hold on and the 5-day moving average would catch up to it and show some base building here for potential strength. But we were still talking about the fact is we have lower highs and lower lows, so it's not in a good position for purchases. You can look at it and say, hey, it's at support, and if you want to gamble and see if that support holds, then a stop below the low for the year is where you might want to put a stop. Personally, I'm not a gambler. I don't want to test. I don't want to guess where support is. We've got a declining 5-day moving average. Year to date, the average price that this stock is traded at, the volume weighted average price, is 108.77. So you can see here that this was support. So for this stock to become more neutral again, I think we're going to need to see it back above 109. That's to get it neutral. The sellers are in control here on the intermediate term time frame. We're at a potential level of support, and it's starting to stabilize for half a day here, but clearly it's not in a condition to be bought, in my opinion. If you do buy, here, if that's your strategy, I'd suggest you put a stop underneath this low right here. Amazon did lose ground here this week, so we were talking about this one as being in trouble, and you know, it lost some pretty good ground this week. It is at a bigger area where we've got potential support, but again, the pressure is building here. We've got lower highs. What does this tell us? This tells us that, you know, the sellers aren't taking control at 390 or 385. Instead, you know, the sellers took control at 395. It dropped down to 290, and then it bounced, and the sellers didn't wait for it to get back to 385 again before they took control. Instead, they took control at 360, and then it dropped down and tested that support once again. Then the sellers took control at 345. So the sellers are getting more aggressive in terms of price, because they're not waiting for higher prices before they get out, and they're getting more aggressive in terms of time, because the time in between these tests of support is diminished as well, and that says the sellers are becoming more aggressive price-wise and time-wise, and often we see that this support will be broken. Now, it doesn't typically get broken after a decline of 314 down to 285. So, you know, we saw a 10% drop. It's probably due for a little bit of a bounce, but this bigger level is still quite suspect, and the sellers are telling us they're becoming more aggressive price-wise and time-wise. So to me, it doesn't look like a good opportunity. Data we spoke about is a potential trade that would set up, in particular if it could get above 88, and I said, you know, we don't want to see a gap above there. We want to see, the ideal scenario would have been for it to rally up towards there, pull back, create the higher low, then break out, buy that high, go back to last week's high video, and then set our stop below that higher low. Instead, what we saw is it gapped up, it pulled back, and then it just continued to pull back. So even if you had purchased at 88, there was no reason to continue to be holding below that low that it had made the morning of the gap up. At worst case, I think you should have lost, you know, maybe $1 or so. This is a risk management strategy that we talk about every single day in Alpha Trends. So if you need help with risk management, with good stock trading ideas, with looking objectively at what the market is doing, take a free trial for 7 days and see what it's all about. By the way, there's a new trading tool on alphatrends.net. If you go to alphatrends.net and just look at tool at the top, you'll see there's a position size calculator that should help you. So there's some good tools on there educationally to help you with risk management, with pivot levels and Fibonacci and that sort of thing. So take a look at those if you haven't. Anyways, Google continues to kind of be a mess. We spoke about it becoming more neutral above 510, and you can see here that, you know, we broke a little bit of resistance. So the intermediate term, it's starting to turn more neutral here. We've got the 5-day moving average making a higher high, and we've got this the 5-day moving average turning higher, rather. That is, it has an upward slope to it, and it broke some resistance here. So, you know, maybe you buy it with a stop under here, but when you look at that daily chart, it's just a mess. It's in a downtrend, it's rallying on lighter volume, and it looks like it's still quite dangerous. Shares of GoPro, we spoke about the fact that, you know, they were breaking the volume weighted average price since the stock came public. It got smashed this week. Anyone who is, you know, looking to be long a stock, don't buy it if the 5-day moving average is declining. Expect to lose money if you do. The stock is in a downtrend. It's broken. It's guilty till proven innocent. I saw people talking about, hey, it's at support. This is where to buy it. There's no sign of support. It continues to deteriorate. It's below the declining 5-day moving average. It's guilty till proven innocent. Netflix rallied a little bit from this level that has shown support at 310, 320 here. And, you know, realistically, it's pretty sold off and maybe due for a bounce, but it's a messy, ugly chart. The 50-day moving average is declining, and that tells us also don't look for anything longer term as far as upside. We spoke about Tesla having its best days behind it for now. It closed last week at about 206, I believe, and you know, it's stuck below a declining 5-day moving average. So you should expect to see that prices will continue lower until it can do something like this. This would have been a scenario for Tesla to maybe stabilize. This kind of go like this, and then, you know, create higher lows and see that 5-day moving average begin to flatten out. And then if it breaks resistance, then maybe you could get going a little bit here. But again, with a daily chart, with a declining 10, 20, 50-day moving average, with a declining 50, 100, 150, and 200-day moving average, the odds just aren't good for buyers in Tesla. So I continue to say stay away from it. Stay away from Alibaba. Alibaba, it was, you know, trying to find some support, stabilizing near the volume weighted average price since the stock came public, and yet it was still having trouble with that 5-day moving average. And here we are, another 10 points lower or so in Alibaba. So, you know, learn to focus on what are the trends, not on your opinion of what's a good company, what's fair value, or any of that. What's the trend? What is a low risk, high probability trade? And if you don't see it, then don't trade that stock. They're just stocks. They're a means to an end. Our job as traders is to find the low risk, high probability trades and align ourselves with that trend. That's what we do every single day at Alpha Trends. Come take a look. Hope you had a good week, and thanks for tuning in.